Well, interesting week in global markets. The US Federal Reserve's decision to maintain interest rates, coupled with President Donald Trump's announcement of a new trade deal with the UK, has stirred investor sentiment. Stock rising this Friday morning as Trump suggested a cut to US tariffs on Chinese imports. Meanwhile, gold prices have experienced volatility this week. Well, commodities strategist at TD Securities, Daniel Ghali, joins me now. Daniel, thanks very much indeed for your time.
Yeah, thank you for having me.
It has been an interesting week, the Fed holding rates steady and the announcement of this US-UK trade deal. Just what's been the general, impact on markets as we see those developments happening this week?
Well, I think what's particularly interesting is that with respect to the, Fed policy on its impact on gold prices, there's been increasingly a disconnect. And actually, this has been building for a few years now. And I think that's ultimately symptomatic of the fact that the network of participants that are buying gold is starting to change. Right? The cohorts that tend to care about what the Fed will do are Western traders that tend to look at gold as a substitute for, let's say, an infinite duration zero coupon bond. In contrast, in the East, I think that currency depreciation fears are really the big driver for gold purchases, and those have been driving, Chinese gold ETFs, for instance, to accumulate a substantial amount of inflows this year.
Yeah, I want to talk about that. Just looking at what the central bank in China is doing, given the recent fluctuation in the gold prices. I mean, dare I ask, though, are we reaching a peak with gold?
Yeah, I think, it's so interesting because gold prices have had a phenomenal run, and we've reached a stage in this melt up, if I can call it that, where sentiment is actually, I'd say, even potentially outright bearish for most of the people that or our read of the market. I think really that's symptomatic of the fact that those typical Western traditional macro funds that participate in gold markets have actually missed out in the last leg of this melt up. They've missed out because heading into Liberation Day, there were substantial concerns around a deleveraging event. This is an event where, the levered participants in markets can indiscriminately sell across equity markets, bond markets, gold markets, and so on and so forth. And as a result of that fear, they actually flattened out their positions. Overall, we estimate that's around $33.5 billion worth of gold that was sold from this one cohort since President Trump was elected in November of last year. They've managed to sell that much without having any impact on the prices, right? Without weighing on gold prices. And again, I think that is symptomatic of the fact that the network of people who are buying gold is now changing.
Daniel, what did you make of the stream of mining company results this week? What are they reflecting when you compare them to the actual metal itself? Now, understandable, we're not talking about any specific companies here, but you had Kinross Barrick, B2Gold, all giving you some quite interesting results this week. How do you measure metal versus the stock?
Well, I think what's perplexed many people is that the commodity is performing a lot better than the aggregate mining complex, and ultimately, I think this in some ways makes sense. It makes sense because the demand for the commodity is not equivalent to the demand for that sector. So what we're seeing, lift the gold price over the last several years is a broadening group of central bankers who are participating in gold markets, a increase in Eastern buying activity, and really, these are independent forces to the sector itself.
You previously highlighted silver as the squeeze you can buy. I mean, with the current market conditions, do you see silver poised for any significant breakout here? And what are the implications in terms of silver mining companies?
Yeah, it's a great question. And I think really, if we go back in time to earlier this year, silver had unique implications deriving from the tariff regime. Those unique implications were centered around the fact that we've been 5 years into a structural deficit. That deficit has already eroded the pool of available inventories of silver that are freely available for purchase in London. And our concern was that if bullion was not exempted from the tariffs, the metal that would have flowed into the US would no longer be available to the world. And so it would, in effect, be equivalent to a one-time drain on the pool of metal available to the world. That is fundamentally bullish. Where we've landed now, of course, we know that bullion in many ways has been exempted from the US's tariffs. And so there is a level of tightness that in London that can re-attract inventories from the US to replenish London vaults. And therefore, the silver squeeze you can buy into, as we've called it, will still come back into play in a few years. But we have a lot of wood to chop through before we get there.
Yeah, and let me extend to another quick metal here, copper prices. I mean, they've shown some resilience amid some global economic shifts. Depending on who you ask, you'll get a different answer as to what the future looks like for copper. What's your quick take on it?
Well, here's what's interesting. And, you just mentioned silver, now copper. What if I told you that about 40% of the day-to-day variation in prices that are common to silver and copper and wheat and any other commodity you can think of are being driven by one common factor? That's up from about 17% prior to Liberation Day. And really what that's telling you is that the markets are trading in a recessionary regime. The recession odds are really the only large driver for all commodities prices right now, or at least for industrial-oriented commodities such as copper and silver. And so what does the outlook suggest, right? We know, as has been discussed, time and time again, that we are going to head into a period of time where copper will be in a structural deficit. It's hard to be bearish in that context. But between now and then, we could very well see a significant deterioration in economic growth that could still bring copper prices lower. And again, delay or disincentivize investment into future supply. So this context is actually really critical for the state of the energy transition, because the world does need more investment in mining in order to satisfy that energy transition.
Yeah, very interesting space to watch. Well, thanks very much indeed, Daniel Ghali from TD Securities. Pleasure speaking to you.
Yeah, thank you so much for having me.